What's up guys, and welcome back to WSM Research. On this channel, we cover everything related to stocks and investing. Today there was some major news relating to a stock we follow on this channel, and people who bought the stock will be very happy to hear it. The stock is Magnichip, and they recently received a bid to be bought for a huge premium of its public stock price by a private equity firm, causing the stock price to immediately jump 30%. If you like these videos, make sure to hit that like button. With that, let's get into the details of the announcement. On Friday, March 26th, Magnichip, ticker symbol MX, spiked by 30% on the open. It was reported in the pre-market that the South Korean semiconductor manufacturer announced that it had entered into a definitive agreement to be taken private by a private equity company. The exact terms of the agreement make it clear why the stock price jumped so much. Under the terms agreed upon by Magnichip, each shareholder will receive $29 for each share that they hold. That was a 75% premium over the volume-weighted average price of Magnichip shares over the past 3 months. The transaction would be all cash and be worth a total of $1.4 billion. The private equity firm involved is Wise Road Capital, a global private equity firm that specializes in the technology sector. In particular, they focus on technology that has relevance to smart and green technologies, as well as renewable energy. They have deep industry expertise, according to Magnichip's CEO. Additionally, the closing of the deal is not contingent on financing conditions, but is as usual subject to shareholder and regulatory approval. The deal is expected to close in the second half of this year. This deal is very important for all shareholders because it represents the existing stock being bought out for a very significant premium. Right before the deal was announced, the stock was at $20.39 a share, but Wise Road Capital had agreed to pay $29 a share, a 50% premium. Even after the announcement, at the end of trading on March 26th, Magnichip was still trading at about $26 a share, which implies an 11.5% upside to the stock. Theoretically, an experienced investor could buy the stock at the current price or engineer a financial derivative strategy to bet on the stock price being at $29 at some point in the second half of the year. This would attempt to take advantage of the apparent arbitrage opportunity. However, agreements like these always have the risk of being blocked by regulators or other causes, and thus inherently carry large amounts of risk. We first mentioned Magnichip in this video on March 11th. At the time, the stock price was $22.53, and we said it looked insanely undervalued based on its strong balance sheet and earnings outlook. With the rise of work from home, there's been a huge surge in demand for consumer electronics, and the semiconductor companies that make the electronic components are struggling to keep up with demand. The chip shortage has gotten so bad that NIO was recently forced to suspend some of its production lines because they can't get their hands on the computer chips that power the car's systems. This is a significant tailwind to semiconductor stocks, as prices are rising and their profit margins are inflating. The CEO of Intel says that the chip shortage likely won't be resolved for 2 years, so semiconductor companies will likely print massive earnings beats for the foreseeable future. But a lot of this good news has already been priced in, with the SOXX semiconductor ETF more than doubling over the past year. In these frothy market conditions, it's very important to be selective and pick semiconductor stocks with both strong prospects and reasonable valuations. And Magnichip fit this description perfectly. Magnichip is the largest independent supplier of OLED display drivers, which are necessary for the production of OLED screens in smartphones, TVs, and even automobiles. There are huge secular tailwinds driving the OLED market, as more and more car models include OLED display screens. While there are many high-flying tech stocks playing in secularly growing industries, Magnichip stock was especially compelling because of its dirt-cheap valuation. In March of 2020, they sold their foundry and a manufacturing plant for $435 million. They used the proceeds from the sale to pay down more than $200 million of debt, bringing their net borrowings down to $83.5 million. They also had $280 million of cash and cash equivalents. If you subtract their $83 million of debt, that gives them a net cash position of almost $200 million. At the same time, their market cap was just over $1 billion. Subtracting $200 million of net cash gives an enterprise value of just $800 million. Adjusting for their disposition of the foundry, they made $28 million of net income for the full year of 2020, which is more than triple their net income of $9 million in 2019. And with a chip shortage showing no signs of resolving itself anytime soon, revenue and earnings will probably be even higher in 2021. In 2020, they had $15 million of interest expense, but now that they've paid off all of their debt, they will no longer incur this expense going forward. If we take out $15 million of interest expense, 2020 net profit would have been $43 million. Conservatively, assuming they make $43 million of net income in 2021, at $22.5 a share, they would have a price-to-earnings ratio of 18.6 times. This is an insanely cheap valuation for a company with zero debt and benefiting from long-term secular tailwinds in OLED displays. We weren't the only ones who noticed Magnichip was trading at a compelling valuation. Private equity firm Wise Road Capital also thought they were undervalued and made a deal to buy the company at a 42% premium to its share price. Magnichip is just the latest stock to announce an acquisition that rewards long-term shareholders. This way of being rewarded for finding undervalued stocks is not new at all and is one of the three primary ways that diligent investors can be rewarded for their investments. The second way is stock buybacks, in which a company uses cash from its balance sheet to buy shares of itself on the open market. Share buybacks are great for long-term buy-and-hold investors because they allow the value of the company that is in the form of cash to be transferred into value in the form of increased ownership in the company. Additionally, gains from share buybacks are not taxed as capital gains or dividends, so there is a significant tax advantage for investors. The third way that companies return capital to shareholders is through dividends. Dividends are self-explanatory. If a company has significant free cash flow or excess liquid assets, it may issue dividends to its shareholders. Shareholders must pay the dividend tax on all dividend income, which can range from 15 to 20% for qualified dividends or the same as your income tax rate for non-qualified dividends. Consult a tax professional for all official information. All styles of long-term investing benefit from these mechanisms of shareholder returns. Value investing tries to find stocks that are inherently discounted by the markets for whatever reason, perhaps because they have been forgotten by investors or there is some risk that might be overstated. Growth investing tries to find stocks that will have enhanced earnings power in the future as a result of growth. After the growth happens, this earnings power could be used to pay dividends or buy back stock. Another style of investing, which is sometimes considered a subset of value investing, is finding stocks that are trading at below their book value. In these cases, the value of the stock is the actual value of its assets minus liabilities. If this net value is lower than the price of the stock, investors can buy it and try to convince the company to pay out the book value in a special dividend. In all of these strategies, if a private equity firm or other company thinks that they can unlock value in the company by taking over control of the company, they can try to pay its existing shareholders a portion of the value they think they can unlock in order to take the company private. This is what happened with Magnichip, and so far everyone wins. Alright guys, that wraps it up for this video. If you liked this content, make sure to smash the like button and subscribe for future updates. Also, make sure you're following us on TikTok and Instagram. As always, thank you so much for watching, and we'll see you in the next video. WSM Research, signing out.